His name was Nelson Bunker Hunt. He worked out of the oil fields of East Texas and the boardrooms of Dallas, managing one of the largest private fortunes in the United States. It was 1973, and he was 47 years old. He wore ill-fitting suits. He drove an old car. He flew economy class. He did not drink. He did not smoke. He was not a gambler in the conventional sense. He was a man who had studied what happened to paper money across 2 centuries of recorded history, and he had reached a conclusion that most people considered paranoid, but that every economic textbook would eventually confirm: fiat currency loses purchasing power over time, and the people who hold it without a physical hedge pay for that loss silently, gradually, and completely. His father, Harrelson Lafayette Hunt, had watched the dollar function during the Great Depression. He had built an oil empire during an era when money was still anchored to gold, and he had told his sons one thing repeatedly: when the anchor is removed, hold something real. In 1971, President Richard Nixon closed the gold window, ending the convertibility of the dollar into gold that had been guaranteed since the Bretton Woods Agreement of 1944. In the decade that followed, the dollar lost purchasing power at a rate that made his father's warnings look understated. By 1979, annual inflation in the United States was running above 13%. The price of oil had quadrupled. The Iranian hostage crisis was underway. The Soviet Union had invaded Afghanistan. The consumer price index was accelerating. Anyone who had held savings in a bank account since 1970 had watched its real purchasing power erode by roughly 40%. Bunker Hunt drew a conclusion from this environment. He was wrong about almost nothing. He was right about the dollar. He was right about inflation. He was right about the structural debasement of paper currency. He was right that a physical commodity with genuine industrial utility and a constrained supply was a rational hedge. And he would lose everything precisely because he was right. That is the mechanism this video examines. Not the behavior of Bunker Hunt, but the behavior of the system that destroyed him when his position became large enough to threaten it. You are standing in the COMEX trading pit in New York, January 21, 1980. Silver is trading at approximately $42 per ounce. 6 months ago, it was $11. A year ago, it was $6. The Hunt brothers and their associates now hold an estimated 195 million ounces of silver, physical bars stored in vaults in Zurich, in Dallas, in London, plus futures contracts representing another 90 million ounces. That is approximately 1/3 of all the silver in the world that is freely tradable, outside government stockpiles. The price has risen 713% in 12 months. Paper gains on their position approximately $4 billion. On paper, Nelson Bunker Hunt and his brother William Herbert Hunt have executed one of the greatest commodity trades in the history of financial markets. Here is what blows people's minds. On that same day, January 21, 1980, the COMEX Board of Governors votes to impose what they call liquidation-only trading in silver. No new long positions may be opened. Traders who hold silver futures contracts can only close them. They cannot roll them forward, and they cannot add to them. New buyers cannot enter the market. Only sellers can act. The mechanism that made the Hunt's position profitable, new demand absorbing new supply, is switched off by the people who run the exchange. Read that again. In the middle of a trade, with players holding winning positions, the exchange declares that only one side of the market may operate. This is not ancient history. This is documented. It is in the congressional record. It is in the SEC's own investigation report. And when William Herbert Hunt was asked about it before Congress, he stated plainly what the records later confirmed. The board members who voted for this rule held large short positions in silver. They were the counterparties. They were the ones who would lose if silver continued to rise. The people who rewrote the rules were the people who were losing money on the other side of the Hunt's trade. Let me build this properly from the beginning, because what happened to Nelson Bunker Hunt between 1973 and 1980 is not a story about greed. It is a forensic case study in what the system does when an outsider accumulates enough of a commodity to threaten institutional control of its price. The background matters. In 1971, when Nixon closed the gold window, American citizens were still prohibited from owning gold bullion. That prohibition had been in place since Franklin Roosevelt's Executive Order 6102 in 1933, the same order that required Americans to surrender their gold coins and certificates to the Federal Reserve at a fixed price of $20.67 per ounce, after which the government immediately revalued gold to $35. The people who complied lost 40% of the real value of their gold holdings in a single administrative act. The people who did not comply were technically subject to criminal prosecution. Gold was returned to private ownership only in 1974. But by then, Bunker Hunt had already identified the alternative. Silver was legal. Silver was trading at less than $2 per ounce in the early 1970s. Silver was an industrial metal with genuine demand from photography, electronics, and medical equipment manufacturing. And silver, unlike the dollar, could not be printed. Bunker Hunt began accumulating in 1973. Not dramatically, systematically. He bought physical bars. He arranged for delivery, real metal, not paper claims. He transported millions of ounces to vaults in Switzerland under private security. When his futures contracts matured, he took physical delivery instead of settling in cash, which is what most futures traders do. Every bar that left the COMEX warehouse reduced the exchange's deliverable supply. This was legal. This was, in fact, precisely what a futures contract entitles you to do. He was not breaking the rules. He was following them exactly. By 1974, Hunt and his brother Herbert had accumulated tens of millions of ounces. By 1979, their position had grown to include Saudi Arabian investors as partners, a detail that would later be used to politically frame their activity as a foreign threat to American markets, even though the capital was entirely private. By the last 9 months of 1979, their total position was estimated at 100 million ounces of physical silver and another 90 million ounces in futures contracts. The price had moved from $6 per ounce on January 1, 1979 to $49.45 per ounce on January 18, 1980, a 13-month gain of 713%. The system began to feel this. Tiffany and Company took out a full-page advertisement in the New York Times to condemn what they called unconscionable hoarding of silver. Doctors reported that the cost of silver-based X-ray film for patients had become prohibitive. Jewelry manufacturers were raising prices monthly. Families across America were melting down their heirloom silver flatware and driving it to Holiday Inn parking lots to sell to dealers. The price of silver was not just a number on a screen. It was visible in everyday life. And the people who ran the institutions that relied on silver as an input, and the institutions that had sold silver futures contracts they now had to cover, were facing losses that threatened their solvency. Here is the brutal math. COMEX board members were among those institutions. The exchange was governed not by neutral administrators, but by the traders and dealers who operated on it. Many of them held short positions. They had sold silver futures contracts betting the price would fall. When the price rose instead, they owed the difference. At $49 per ounce, the losses on those short positions were not abstract. They were existential. As W. Herbert Hunt later testified to Congress, these board members had a direct financial interest in seeing the price of silver fall. The people who ran the rules were the people losing money on the other side of the trade. The first move came on January 7, 1980. COMEX adopted what it called Silver Rule 7. This rule placed heavy restrictions on the purchase of commodities on margin. Leverage buying of silver futures was effectively curtailed. The Hunts had used leverage extensively, borrowing against their silver holdings to buy more silver, a strategy that amplified their gains on the way up, but created a structural vulnerability. If the price fell, they would face margin calls they could not meet without liquidating. Silver Rule 7 was designed to stop new buyers from entering the market. Without new buyers, price support would erode. The Hunt's position would begin to move against them. On January 18, 1980, silver hit its all-time high of $49.45 per ounce on the London FIX. COMEX futures briefly touched $50.35 intraday. The Hunt's paper position was worth approximately $4.5 billion, built from an initial investment of roughly $400 million of their own capital. They had made $4 billion on paper. They are wrong. Because what they have not fully priced is that the exchange can stop the game while they are winning. On January 21, 1980, 3 days after the peak, the COMEX Board of Governors votes to impose liquidation-only trading. The Chicago Board of Trade follows suit on January 22nd. These two decisions eliminate the buying side of the silver market. No new long positions, only closures. The architecture of the market has been re-engineered in real time, while the Hunts hold their position. New buyers cannot enter to support the price. Existing longs who face margin pressure begin selling. The price begins to fall, not because the fundamentals of silver have changed, not because inflation has suddenly reversed, not because the supply of silver has increased. The price falls because the rules have been changed to make it fall. By late February 1980, silver has retreated from $49 to $21. The Hunt's paper gains are shrinking rapidly. Their position requires them to pay margin on their futures contracts as the price falls. Each dollar the price drops requires more cash from them. They go to their brokers. They go to their banks. They borrow against their oil assets, their real estate, their art collection, their racehorses. Bunker Hunt was one of the world's largest thoroughbreders, with more than 8,000 acres of farms in Kentucky and one of the most successful racing programs in Europe. He had won the Derby in 1976. None of it was enough. Quick pause. If you are beginning to see the mechanism, not the individual, the mechanism, hit subscribe. This is the Money Architect. I do not tell you what to buy. I show you how the system was built, who designed the trap, and who walked away when it closed. It is free, unlike the lesson Nelson Bunker Hunt paid in 1980. On the morning of March 27, 1980, the price of silver opens at approximately $15.80 per ounce. The Hunts receive margin calls totaling $100 million from their broker, Bash Halsey Stewart Shields. By noon, they cannot pay. Bash Halsey Stewart Shields, the brokerage that holds the Hunts futures positions, is itself now facing insolvency. Because if the Hunts default and the collateral backing their account is insufficient, Bash-How absorbs the loss. This is the contagion the system feared. One failure cascades into the next. Brokerages fail. Banks that lent to the Hunts face impaired collateral. The credit system tightens. A financial crisis begins. By the close of business on March 27, 1980, the day known forever after as Silver Thursday, silver has fallen from $21.62 at the open to $10.80, a 50% single-day decline. $7 billion in paper assets have become a $1.7 billion debt. The Hunts, who were among the 5 wealthiest men in America at the beginning of 1980, are now possibly the largest individual debtors in the United States. Here is what history shows. A consortium of American banks, led by Citibank and Bank of America, convenes an emergency meeting with Federal Reserve Chairman Paul Volcker. Volcker, who had already quietly encouraged banks to stop lending for precious metal speculation in the weeks prior, now oversees the construction of a rescue package. A group of banks provides the Hunts with a $1.1 billion line of credit, collateralized by their remaining assets, their stake in Placid Oil, their real estate, their horses, their art. The banks now hold title to the things the Hunts built their lives around. The Hunt brothers had borrowed to buy silver. Now the banks that changed the credit environment after Volcker's guidance own what the Hunts pledged. And here is the layer that the official record tends to bury. Many of the banks that participated in the consortium that bailed out the Hunts had board members who also sat on the COMEX board. The same institutional network that voted to impose liquidation-only trading, effectively engineering the price collapse, also held the collateral for the rescue loan. They had the winning position on the short side, then they acquired the Hunt's real assets at distressed prices. This is not theory. This is the documented structure of who sat where. The Fortune magazine investigation of July 1980 noted specifically that the COMEX Board of Governors was made up of the same traders and dealers who were short silver, people who had a personal financial interest in the outcome of the very rules they were voting on. Chairman Ralph Peters at the Chicago Board of Trade had the decency to recuse himself from the vote. The COMEX equivalent did not. The aftermath unfolds slowly. By 1982, the London silver fix had collapsed 90% from its peak, settling at $4.90 per ounce. The price had been at $49 2 years earlier. By 1988, Nelson Bunker Hunt and William Herbert Hunt were found civilly liable for conspiring to corner the silver market. A federal jury ordered them to pay $134 million in damages to Minpeco, a Peruvian government mineral company that had lost money as a result of the price movements the Hunts had driven. The Hunts were ordered to pay this to a party that had been short silver, exactly the position the COMEX board members themselves held. By September 1988, both brothers filed for personal bankruptcy to avoid posting the required appeal bond. By December 1989, they settled with the Commodity Futures Trading Commission, $10 million fines each, and a permanent ban from trading in American commodity markets. Nelson Bunker Hunt's net worth had been estimated at $5 billion in 1980. By 1988, it was below $1 billion. By the mid-1990s, his personal trust held approximately $175 million. He sold his oil fields. He liquidated his thoroughbred operation in a dispersal sale at Keeneland in 1988, 580 horses, the life's work of 30 years, auctioned for $46 million, the highest auction total in thoroughbred history at the time. Everything built over a lifetime, converted back to cash at whatever price the market would bear. The same market whose rules the system had rewritten while he was winning. Here is what nobody tells you about this story. The question that history asks is not whether Bunker Hunt broke the rules. The question is whether the rules were designed to be breakable only in one direction. A commodity exchange is supposed to operate as a neutral marketplace. Its board of governors are supposed to set rules that protect the integrity of the market, not protect the positions of the people setting the rules. When COMEX implemented Silver Rule 7 on January 7, 1980, and when it declared liquidation-only trading on January 21, it did so while the people making those decisions were losing money on the other side of the trade. This is documented. It is in the congressional record. It is in W. Herbert Hunt's own testimony. The Wall Street Journal reported it. Fortune investigated it. No one was charged with market manipulation for changing the rules. The people who changed the rules to save their short positions were never prosecuted. The people who were long silver were convicted of conspiracy. Same pattern, same stages, same outcome. Fast forward to 1996, Yasuo Hamanaka is the chief copper trader at Sumitomo Corporation in Japan. He has been accumulating copper for 10 years, controlling at one point approximately 5% of the world's entire copper market. His nickname among traders is Mr. Copper. When his positions are unwound by his own employer after an internal investigation, copper falls from $2,800 per metric ton in May 1996 to $1,800 on June 25, 1996. Sumitomo announces losses of $1.8 billion. Those losses eventually swell to $2.6 billion as the positions are closed into a broken market. Hamanaka is sentenced to 8 years in prison. The institutions on the other side of his trade are not charged. The pattern: accumulate to the point of threatening institutional positions, watch the regulatory framework adjust, absorb the collapse. Now consider January 28, 2021. GameStop is trading at approximately $483 per share in pre-market hours, up from $17 at the beginning of the month. a gain of 2,700% in 25 days. Retail investors, coordinating through a Reddit forum called Wall Street Bets, have identified that hedge funds are short the stock beyond the total public float. More than 140% of GameStop's available shares have been sold short. The mechanics of a short squeeze are forcing those hedge funds to buy back shares at any price to cover their positions. Melvin Capital, one of the most prominent short sellers, is losing more than $1 billion per day. On January 28, Robinhood, the retail brokerage platform through which most of the buyers are operating, announces that it is halting new purchases of GameStop. Users can sell, they cannot buy. Within hours, the price collapses. Melvin Capital is bailed out by a consortium that includes Citadel Securities, which has a payment for order flow relationship with Robinhood. The platform that halted retail buying received revenue from the institution whose counterparty was being squeezed. Not theory. This is documented in the congressional testimony that followed. The fine Robinhood paid was $70 million. The hedge fund losses it prevented were measured in billions. 3 events. 3 different decades, 3 different markets. Same mechanism. A private party accumulates a position large enough to threaten institutional counterparties. The institutional counterparties control or influence the rules of the market in which the position is held. The rules change. The position collapses. The private party is destroyed. The institutional counterparties recover and in some cases acquire the distressed assets of the party they destroyed. Not theory, not speculation. Historical fact. The pattern is mathematical. The outcome is structural. Here is what it reveals. A commodity exchange, a stock exchange, a futures market. These are not neutral infrastructure. They are institutions operated by participants with their own positions and their own interests. When those institutions are governed by the same parties that stand to gain from a rule change, the market's claim to neutrality is conditional. It functions neutrally as long as no single participant gets large enough to threaten the people who run it. The moment that threshold is crossed, the rules become the weapon. This is not an argument that the Hunts were blameless. They used leverage aggressively. They accumulated positions of a scale that created systemic risk. A regulated market has legitimate reasons to constrain position sizes and margin requirements. These are defensible governance tools, but defensible governance requires that the people setting the rules not simultaneously hold the positions that benefit from those rules. The minutes of the COMEX board meeting of January 21, 1980 were kept confidential for years. The exchange president told journalists the information was privileged. The congressional investigation uncovered what those minutes contained. Here is what history shows about the people who profited from Silver Thursday. The banks that held the Hunts' collateral acquired oil assets, real estate and business interests at distressed valuations. Bush Halsey Stuart Shields, the brokerage through which the Hunts had operated and which held 25 million ounces of their silver as collateral, survived the crisis because the consortium loan was structured to flow through it. Merrill Lynch, which held another 20 million ounces of silver collateral, also stabilized. The short sellers who held positions on the COMEX board covered those positions at prices engineered by the rules they had voted for. Their names are not in the bankruptcy filings. Their names are not in the CFTC settlement. The party that was banned from American commodity markets forever was not them. Nelson Bunker Hunt died on October 21, 2014. He was 88 years old. His family retained some wealth. His son Clark Hunt inherited the Kansas City Chiefs from his uncle Lamar and has built the franchise into one of the most valuable in American sports. The Silver story is remembered as a cautionary tale about speculation and leverage, which it is. But it is also a record of something more specific, the documented use of exchange governance to destroy a winning position held by a party who threatened the positions of the governors. That is a different kind of cautionary tale. The modern parallel has a specific number attached to it. As of 2025, the 10 largest participants in global commodity markets hold positions that dwarf what the Hunts assembled in silver. The position concentration in gold, crude oil, and government bond futures among a small number of institutional counterparties is not a secret. It is reported quarterly to the CFTC in what are called Commitment of Traders reports. The largest participants in these markets hold positions that would be classified as systemic risks if held by private individuals. They are not classified as systemic risks because they are the institutions, they are the counterparties. They sit on the governance boards of the exchanges on which they trade. This is not an argument that those positions will collapse. It is an observation that the rules defining what counts as acceptable accumulation are not written by neutral parties. They are written by the people who have the most to lose if someone else accumulates too much. The Hunt brothers' silver was taken from them through rule changes. Their assets were acquired by the institutions that changed the rules. The legal system then confirmed that the Hunts had broken the law and not the institutions that changed it while holding opposing positions. Now go read the Commitment of Traders report before you decide who writes the rules in the markets you use.